Hi folks, CB3 here with another live update. What's the best way to save for retirement? Is it an IRA, is it a Roth, or is it a SEP-IRA, or possibly is it all three? We'll talk about that in this episode. CB3 Live Update begins now. So the obvious question is, why not just open a brokerage account and save for retirement that way? And the answer is taxes. The IRS requires that you pay taxes on any gains that you make in a given calendar year in a regular non-retirement account, a brokerage account, a joint account, even a trust account. So that's why IRAs, Roths, and SEP-IRAs have become so popular. Now, there are plenty of other vehicles as well, 403Bs, 457s. We're not going to cover that in this episode. I want to cover the main three because I've had 3 clients ask me this month about this and what's best for them. So obviously, it's unique to every single person as to what is best for you, but here's how it works. When you save in an IRA, that money is being tax deferred. So let's say you make $100,000 and you put $7,000 in an IRA this year. You're only going to pay taxes on $93,000 of the $100,000 you made because the IRS is going to give you that tax deduction this year. Why would they do that? Because they want your tax deduction to go into a retirement account that's going to grow really big, and then they're going to make more tax revenue from you years down the road. And that's fine because it's growing tax deferred. The Roth IRA is just the opposite. You do not get a tax deduction in the year that you start funding it. So if you make $100,000, you pay tax on $100,000, but every dollar that's growing in that Roth IRA is tax-free to you at distribution because you paid taxes on it from day one. Actually, we recommend that people have a blend of IRAs and Roth IRAs. Now, both IRAs and Roth IRAs are funded at the personal level. That means you yourself fund this from your own checking account. So now let's talk about the SEP-IRA. The SEP-IRA is powerful because it allows you a much higher contribution level. Let's say you make that $100,000. You can put up to 25% of that or $25,000 into your SEP-IRA. Now that's far more than you can put into a Roth or an IRA. Again, because the way that this is structured is your employer, which would be you, funds this. So an individual cannot fund a SEP-IRA. The whole acronym stands for Simplified Employee Pension. What you have to have is a self-employed status, and then your employer or your company funds that on your behalf. We know many clients of ours that have this, and this question has come up to me 3 times this month, so I thought it was time to do an episode. So here's the exciting news. Just as of last year with the Secure Act 2.0, Congress has provided a way for you to save money in a Roth SEP-IRA. Now, there are some restrictions. Any earnings withdrawn before age 59 and a half are subject to a 10% tax penalty. They don't want you taking it out. I can work through this with you, but the Roth SEP-IRA is a great component add-on to the regular SEP-IRA. You want to use probably a blend of a SEP-IRA and a Roth. So I mentioned earlier that you can have a $7,000 limit in currently this year, 2024, on what you contribute to an IRA or a Roth. You could put $3,500 in each. You could put $5,000 in one, $2,000 in the other. But if you have a SEP-IRA, that is a totally separate animal, meaning you can fully fund that with up to 25% of your annual income, which I just mentioned, and you can still fund your Roth. Now that, for many people, is going to be the way to go because then you're saving pre-tax, getting the tax deduction, and you're saving after tax, not getting the tax deduction, but your money is growing tax-free. So I know this is a little detailed, but if you have questions, you can always reach out to me, cb3@cb3.com, 312-513-7486. We're here at CB3 Financial to help you guys understand what's the best vehicle for you. Everyone's situation is unique, and we'll work through it with you. I'll see you next time on the next episode of CB3 Live Update.